Markets often appear irrational only because people are watching the headline instead of the machine underneath it. That is the first thing I would say about what happened after the ceasefire announcement on the 7th of April. At 5:32 p.m., Donald Trump announced a ceasefire with Iran. The next morning, markets exploded higher. The S&P 500 closed up about 2.5%. The Nasdaq rose almost 3%. The Dow gained more than 1,300 points, marking its best day in nearly a year. A few weeks later, stocks were back at record highs. The easy explanation was that markets were celebrating peace. That explanation was comforting. It was also incomplete, because the ceasefire was already falling apart in real time. The Strait of Hormuz was not suddenly back to normal. Oil traffic had not returned to the pre-war baseline. The structural energy risk had not vanished. The geopolitical problem had not been solved. Yet stocks were ripping as if the world had become safe again. That is why this story matters. If you only watch the headline, you think the market rallied because peace returned. If you watch the structure, you see something else. You see positioning, you see leverage, you see forced buying, you see systematic models flipping, you see options dealers chasing price, you see a market that no longer behaves like the old stock market. People imagine, where rational investors patiently study cash flows and value. You see a feedback machine. The headline was the spark, the positioning was the fuel, and the market structure was the engine. That is why stocks can rise when war is still happening. They are not always reacting to reality. They are reacting to the positioning around reality. To understand this, you have to look at what Wall Street looked like before the rally. The market did not enter the 8th of April calmly. It entered the 8th of April deeply stressed. On the 28th of February, the United States and Israel launched joint airstrikes on Iran. Iran responded by shutting down the Strait of Hormuz. The market had its worst 5-week losing streak in almost 4 years. By the end of March, the S&P 500 was down nearly 9%. That decline created fear, but it also created positioning. Hedge funds were not just cautious. They were aggressively selling, according to Goldman Sachs data from its prime brokerage desk. Hedge fund selling in North America during the first quarter was the largest since April 2020. Gross leverage was sitting above 300%, close to an all-time high. Short exposure to macro ETFs like SPY and QQ reached the highest levels since the pandemic. That is the key. The market was not simply bearish in opinion. It was bearish in positioning. There is a big difference. An opinion can change without moving the market much. A crowded position can create forced buying when price moves against it. That is exactly what happened. Before the ceasefire, many professional investors were positioned for more downside. They had sold equities, they had shorted broad market ETFs. They were betting that the war, the oil shock, and the broader uncertainty would continue to pressure risk assets. And they had reasons. Commodity analysts were warning that the oil supply shock could be larger than anything in history. They were discussing scenarios where the world would need to cut huge amounts of oil demand if the strait remained closed. They were talking about oil prices at levels that could become depressionary, not merely recessionary. That fear was not irrational. The Strait of Hormuz is one of the most important energy choke points on Earth. If it remains restricted, the global oil system is stressed. If oil prices spike, inflation rises. If inflation rises, bond yields can rise. If bond yields rise, equities can fall. If consumers face higher fuel and food prices, earnings can suffer. The causal chain was real. But the mistake many traders made was that they crowded into the same conclusion at the same time. When too many people are short the market becomes fragile in the opposite direction. That is a principle. A bearish story can be correct and still produce a violent rally if the bearish position is overcrowded. The position can matter more than the narrative in the short term. On the 7th of April, the ceasefire announcement hit that crowded structure. The next morning, prices rose at first. That looked like a normal relief rally, but the actual mechanics were more powerful. The first domino was the short squeeze. When someone shorts a stock or an ETF, they borrow shares and sell them. They hope to buy the shares back later at a lower price, return them, and keep the difference. But if the price rises instead, the short seller loses money. If the loss grows, the broker may require more collateral. If the trader cannot or does not want to add more capital, the position must be closed. Closing a short means buying. That buying pushes prices higher. Higher prices create more losses for other short sellers. More losses create more forced buying. That is a short squeeze. It is not emotional in the abstract. It is mechanical. Shorts must buy to exit. When too many shorts are trapped at once, the buying becomes violent. That is what happened when macro short exposure was at the highest level since 2020 and the market suddenly moved up. The ceasefire headline gave everyone a reason to buy, but the real pressure came from the people who had to buy. Forced buyers are different from willing buyers. A willing buyer can wait. A forced buyer cannot. That is why squeezes move fast. But the short squeeze was only the first domino. The second domino was systematic trading. Commodity trading advisors, or CTAs, are rules-based trading firms. They do not care about the moral meaning of the news. They do not debate whether the ceasefire is durable. They do not read the geopolitical situation like a diplomat. They follow price trends. If the trend is down, their models can short. If the trend turns up and crosses trigger levels, their models can buy. That is the nature of systematic trading. Before the ceasefire, Goldman estimated that CTAs were sitting on roughly a $30 billion net short position. Once the market crossed certain levels after the announcement, those models began to flip. They did not simply move from short to neutral, they began moving toward long exposure, that is a large change in demand. Goldman originally estimated that CTAs might need to buy around $40 billion of equities to cover and reposition. The actual number became around $86 billion across 5 trading sessions. That was one of the fastest buying waves in Goldman's records. This is what people miss. The market did not rise only because investors felt optimistic. The market rose because systematic models were mechanically forced to buy as price crossed certain levels. The price moved, the models reacted, the reaction moved price more. That is a feedback loop. Then came the third domino, the options market. Dealers who sell options need to hedge their risk. If customers buy call options, dealers often buy the underlying stock or index exposure to remain balanced. If the market is in a negative gamma regime, that hedging can become procyclical. When price rises, dealers need to buy more. Their buying pushes price higher. That higher price requires more hedging. In a normal stabilizing regime, dealer hedging can dampen moves. In a negative gamma regime, it can amplify them. Before the ceasefire, spot gamma had flagged a negative gamma regime that meant dealer hedging could feed the rally rather than slow it. So the sequence was clear. Short sellers were forced to buy. CTA models flipped from short to long. Options dealers bought as price moved higher. Those 3 forces stacked on top of each other. Short squeeze, systematic flip, dealer hedging. That was the rally. The news gave the market permission. The mechanics created the violence. This is why the mainstream phrase relief rally is too shallow. Relief was the story people told afterward. Mechanics were the reason the move became so powerful now. The strangest part is that the physical world was not confirming the peace story. According to maritime intelligence data from Windward, only 5 outbound carriers were detected moving through the Strait of Hormuz by midday after the announcement. That was roughly a 96% decrease compared with the pre-war baseline of around 130 daily transits. So if the rally was supposedly about the world returning to normal, the physical shipping data did not agree. The strait was not normal. Oil traffic was not normal. The energy system was not normal, but the market did not need the physical world to be normal to squeeze. It only needed the price to move far enough to trigger the position players. That is the distinction. Markets can rally on the easing of fear even if the underlying risk remains, especially when everyone is already positioned for disaster. This is one of the most important lessons for investors. The market does not always move based on whether conditions are good or bad. It often moves based on whether conditions are better or worse than positioning expected. If everyone is bearish and the news is only slightly less bad than expected, the market can rally violently. If everyone is bullish and the news is only slightly less good than expected, the market can fall violently. The gap between reality and positioning matters in this case. Reality remained dangerous, but positioning had become extremely bearish. The ceasefire headline narrowed the gap just enough to trigger forced buying. That is why stocks ripped. Now, this was not the first time this pattern appeared. In December 2018, stocks had been falling on fears of rate hikes. Then Jerome Powell used the word patient, and the Dow exploded higher. It was not simply that one word changed the whole economy. It was that positioning, fear, and policy expectations were stretched. A small change in the narrative triggered a large mechanical response. In August 2024, the Bank of Japan hiked rates for the first time in 17 years. The yen carry trade began to unwind. The Nikkei fell sharply, then bounced sharply. Different catalysts, similar mechanics. A crowded trade unwinds, models react, leverage forces action, price moves become exaggerated. This pattern keeps repeating because the market itself has changed. The old market people imagine is not the market that dominates today. 20 years ago, the market was more heavily influenced by human portfolio managers, analysts, and discretionary investors who studied earnings reports, cash flows, valuations, and business quality. Those people still exist. They still matter in some areas, but they no longer dominate the short-term market structure in the way many people assume. Today, huge portions of the market are driven by passive flows, algorithmic models, leveraged funds, and options hedging. That changes how prices move, according to the source framework. 63% of all U.S. stock funds are now held by passive indexers. That represents more than $13 trillion of money that does not read earnings reports, debate valuation, or ask whether a company is cheap. It follows the index. Passive investing is not bad by itself. For most ordinary investors, low-cost index investing can be a very good long-term strategy. But when passive money becomes a dominant share of ownership, the structure changes. Market cap weighting means the bigger a company gets, the more passive funds must own. If a company rises, its weight in the index rises. If its weight rises, more passive money flows to it. That can reinforce trends. This is part of why the Magnificent Seven became such a large share of the S&P 500. Over 33% in the source framework. The larger they become, the more they dominate the index. The more they dominate the index, the more passive flows support them. That does not mean they are bad companies. Many of them are extraordinary businesses, but it means the market becomes more concentrated and more flow-driven. A large part of the market is no longer deciding what companies are worth. It is allocating based on index rules. That creates feedback. Then look at the active side. The hedge fund industry has also changed. It has consolidated into large multi-strategy platforms, the giant firms running many internal teams with strict risk controls and significant leverage. These funds may run 4 to 8 times leverage. They have tight drawdown limits. When a position moves against them, they do not always sit around and debate the long-term fundamental value. They reduce risk. That means when stress hits, selling can become mechanical. And when the market turns against shorts, buying can become mechanical. Risk rules create forced behavior. That is another feedback loop. Then look at options. Same-day expiration options have become a massive part of SP trading in the source framework. They make up around 63% of all SP options trading on peak days. Over $2 trillion of notional value can change hands in a single session. Every option trade creates hedging needs for dealers. Those hedges happen in real time when the market is in certain gamma conditions. Dealer hedging can amplify price movement. This means short-term options activity can move the underlying stock market. That is a structural change. So when people ask why stocks can rise while war is still happening, the answer is that the market is no longer just a judgment machine. It is a reaction machine. Passive funds react to flows. CTAs react to trends. Dealers react to option exposures. Multi-strategy funds react to risk limits. Short sellers react to margin and losses. Headlines provide the spark. Mechanics provide the move. This is why markets feel irrational. They are not irrational in the sense of being random. They are mechanical in ways most people do not see. Once you understand the mechanics, the rally becomes more understandable. The ceasefire did not have to be real peace. It only had to be enough of a catalyst to force a repositioning. That is a very different conclusion from what traditional financial media often gives you. The media wants a simple cause: stocks rose because peace, oil fell because ceasefire. Investors celebrated reduced uncertainty. Those statements may contain a small piece of truth, but they ignore the deeper structure. A serious investor has to ask who was positioned how before the headline, who was forced to buy, who was forced to sell, what models flipped, where was gamma, how much leverage existed, how crowded was the trade, what flows were triggered. Those questions matter more than the headline. Now, let's think about what happened to oil. After the ceasefire announcement, Brent crude dropped around 13.5%. WTI crude fell over 16%, the largest single-day decline since April 2020 in the source framework that seemed to confirm the relief story. If peace is coming, oil supply risk falls, so oil prices fall. That part is intuitive. But again, the physical evidence was not as clean. If Hormuz traffic remained deeply depressed, then oil's fall was not necessarily proof that the crisis had ended. It may have been a repricing of fear, liquidation of crowded trades, futures, market positioning, and the rapid reversal of disaster hedges. Oil can move on expectations before physical flows normalize. Just as stocks can rally before the war is resolved, financial prices move first. Physical reality follows later or fails to follow. If it fails to follow, the market must adjust again. That is why I would not treat the rally as proof that the danger disappeared. I would treat it as proof that positioning was extreme. This distinction matters for portfolio construction. If you believe the rally means risk is gone, you may chase the market blindly. If you believe the rally is a mechanical squeeze inside a still dangerous environment, you may remain cautious, even while respecting the price action. That is how I would think about it. The market can go up for reasons that do not make the world safer. A rally can be real and still be fragile. Now, one of the most dangerous things investors do is confuse price action with truth. If stocks go up, they assume the world is improving. If stocks go down, they assume the world is worsening. But markets are not truth machines. They are pricing machines. And prices reflect positioning, liquidity, expectations, forced flows, leverage, policy, and narrative. Sometimes prices anticipate reality correctly. Sometimes prices overshoot. Sometimes prices move because one group of market participants is forced to act regardless of fundamentals. On the 8th of April, forced action mattered. Shorts were forced, CTAs were forced by models, dealers were forced by hedging needs. That is a powerful combination. It can move markets even when the underlying macro problem remains unresolved. Now, what does this mean for investors? The first lesson is that being right about the macro story is not enough. You can be right that war is bad, oil risk is real, and inflation pressure is dangerous. But if everyone else is already short, the market can rally violently against that view. The timing can destroy you even if the thesis is logical. This is why position sizing matters. This is why leverage is dangerous. This is why crowded trades are dangerous. A macro view must be paired with an understanding of positioning. If the view is correct but crowded, the market can punish you before it eventually agrees with you. That is one of the hardest lessons in markets. The second lesson is that uncertainty is not the same as bearishness. Markets hate uncertainty, but they also hate being too crowded in one direction. When uncertainty declines slightly or appears to decline, the relief can be large if positioning is bearish enough. The ceasefire did not have to solve the war, it only had to reduce uncertainty enough to make shorts cover. That is why markets rallied. The third lesson is that modern market structure amplifies moves. A market dominated by passive flows, leverage, Connecticut as, and options hedging does not behave like a calm weighing machine in the short term. It behaves like a machine full of triggers. When one trigger fires, it can fire the next one, then the next one, then the next one. That is why moves can be so fast. A human investor may think in days and weeks, a systematic model thinks in price levels, a dealer hedges instantly. A margin call does not wait for a thoughtful essay. This difference in time scale matters. The market can move faster than human interpretation. That is why the explanation often comes after the move. Now, the fourth lesson is that the old distinction between fundamental investing and technical market mechanics has become less clean. Fundamentals still matter over long periods. Earnings, cash flows, productivity, margins, capital allocation, and business quality matter. But over short periods, the plumbing can dominate. If you are a long-term investor, you need to understand the plumbing enough not to be shaken by it. If your portfolio falls or rises violently on a headline, it may not mean the intrinsic value of your company's changed that much. It may mean positioning and market structure moved price that can create opportunity. But only if you understand the difference. The fifth lesson is that passive investing has side effects. Low-cost index investing is good for many people. It reduces fees. It reduces the need to pick winners. It keeps investors disciplined. But when passive ownership becomes too large, it can reduce price discovery and increase concentration. The largest companies receive more flows because they are largest. That creates a loop. If the loop goes up, it feels wonderful. If the loop reverses, it can become painful. A market heavily concentrated in a few large names can become vulnerable if those names stumble. The Magnificent Seven being over 1/3 of the S&P 500 means that a small group of companies has enormous influence over the index. That may be justified by earnings and dominance, but it also creates concentration risk. A serious investor should not ignore that. Now, the sixth lesson is about leverage. Leverage makes markets fragile. Gross leverage above 300% among hedge funds means many players have positions much larger than their capital. Leverage increases returns when things go right. It increases forced selling or forced buying when things go wrong. In a leverage system, small changes can create big moves. If prices move against leverage short positions, shorts must buy. If prices move against leverage longs, longs must sell. This is why market moves can become disorderly. The more leverage in the system, the less room there is for patience. Patience belongs to unleveraged capital. Leverage belongs to the clock. That is a principle. If you want to survive market shocks, avoid being forced. Forced behavior is where wealth is destroyed. If you are not forced, you can think. If you are forced, the market thinks for you. The seventh lesson is about options. Options are not just side bets anymore. The size of same-day options means they can influence the underlying market. When dealers hedge, their trades can push the market. When gamma regimes change, the same dealer activity can either stabilize or destabilize price action. This means a stock market move can be driven partly by the options market rather than by long-term investors changing their views. That is another reason why headlines can mislead. The market may look like it is expressing a view about peace, war, earnings, or growth. But underneath, it may be expressing the hedging needs of dealers. That is not intuitive, but it is real. Now, what should a long-term investor do with this knowledge? Not become a day trader. Not chase every squeeze, not assume every rally is fake, not assume every decline is real. The purpose is to gain perspective. If you know that markets can rally violently because of short covering, you do not automatically interpret every rally as a durable improvement. If you know markets can fall because of forced deleveraging, you do not automatically interpret every decline as a collapse in intrinsic value. You separate price movement from causation. That gives you emotional control. Emotional control is one of the most valuable assets in investing. Now, I would think about this rally in 3 layers. The first layer was the narrative. The ceasefire announcement reduced perceived uncertainty. Media called it a relief rally. Investors liked the idea that the war risk had declined. The second layer was positioning. Hedge funds were extremely short. Macro ETF short exposure was very high. Leverage was high. The market was vulnerable to a squeeze. The third layer was structure. CTAs flipped, dealers hedged. Passive flows supported indexes. Multi-strategy funds managed risk mechanically. Options activity amplified price. The rally required all 3 layers. Without the narrative, there may not have been a spark. Without the positioning, the spark may not have produced such violent buying. Without the structure, the move may not have cascaded so quickly. That is how modern markets work. Narrative, positioning, structure. A serious investor studies all 3. Now, there is a bigger message here about uncertainty. Markets do not like uncertainty because uncertainty widens the range of possible outcomes. If the Strait of Hormuz is closed and oil could go to extremely high levels, no one knows how to price earnings, inflation, interest rates, or consumer spending. That uncertainty causes de-risking. But when a ceasefire headline appears, even if it is incomplete, the range of outcomes can temporarily appear narrower. Traders who were betting on extreme downside may suddenly have to reduce those bets. The market does not require certainty to rally. It only needs less fear than was priced. That is why a shaky ceasefire can produce a powerful rally. Again, not because the world is safe, because the market was positioned for something worse. Now, this creates a paradox. The more bearish the market becomes, the easier it is for a small improvement in headlines to create a large rally. The more bullish the market becomes, the easier it is for a small disappointment to create a large decline. This is why sentiment and positioning are not side issues. They are part of the machine. Fundamentals tell you what should matter over time. Positioning tells you how vulnerable the market is right now. A market can be fundamentally risky and still rally if positioning is too bearish. A market can be fundamentally strong and still fall if positioning is too bullish. The market is always balancing both. Now let's look deeper at passive money. When passive funds dominate ownership, the index receives flows regardless of valuation. If workers contribute to retirement plans, money buys the index. If model portfolios allocate to equities, money buys the index. If target date funds rebalance, money buys or sells based on allocation rules. This creates a constant background flow. It can support markets, especially large index constituents, but it can also make the market less sensitive to valuation. In the short term, the money is not asking whether the market is cheap. It is buying because the rule says buy. That is not irrational from the individual investor's perspective. For a person saving for retirement over decades, buying broad funds consistently may be a good strategy. But at the market level, when enough money behaves that way, price discovery changes. The market becomes more flow-driven. That means active price discovery happens at the margin with a smaller share of capital, while passive capital amplifies the result through index ownership. This is another reason moves can be strange. The marginal buyer or seller sets price. Passive capital owns the result. Now, the Magnificent Seven concentration is an example of this. If a handful of companies become a huge share of the index, every dollar into the S&P 500 buys a large share of those companies. If those companies keep rising, their weights rise. That pulls more passive money toward them. The loop can continue for a long time. But concentration creates fragility. If the leaders fall, the index feels it. If options activity around those names is large, dealer hedging can amplify moves. If hedge funds are crowded in or against them, positioning can amplify moves. So concentration plus passive flows plus options can create powerful feedback. That is the modern market. Now, the multi-strategy hedge fund structure adds another layer. These funds operate with strict risk controls. They allocate capital to teams. They use leverage. They manage drawdowns tightly. If a team loses too much, risk is cut. If volatility rises, exposure can be reduced. This creates disciplined risk management, but it also creates mechanical behavior. When many large funds have similar risk systems, their behavior can become correlated. If markets fall, they reduce risk. If shorts move against them, they cover. If volatility spikes, they delever. If prices cross certain thresholds, systematic models react. This can create crowded exit doors. That is why liquidity can disappear at the wrong time. Markets are liquid until everyone needs the same side of the trade. Then liquidity becomes expensive. The 8th of April rally was the inverse of a crash. Instead of everyone selling at once, many players had to buy at once. That is why the market ripped upward. A squeeze is a crash upward for shorts. Now, I want to explain why traditional financial media misses this. Media needs simple stories. A rally needs a headline. A decline needs a headline. Peace, war, Fed, inflation, earnings, recession, AI, oil. These are easy narratives. They are not useless. They help people organize events. But the market often moves because of mechanics that do not fit into a simple headline. Short exposure at pandemic highs does not make a clean headline. CTA trigger levels do not make a clean headline. Negative gamma regimes do not make a clean headline. Dealer hedging flows do not make a clean headline. Passive allocation mechanics do not make a clean headline. So the media says stocks rallied on peace hopes. That is not totally false, but it is not enough. A serious investor must go beyond the narrative layer. Now, there is also a practical lesson about hedging. If a hedge becomes crowded, it can fail in the short term. Many investors may have hedged the war risk by shorting equities or buying oil exposure. When the ceasefire headline appeared, those hedges reversed sharply. Oil fell, stocks rose. Anyone too aggressively positioned for disaster suffered. A hedge is supposed to protect the portfolio, but if the hedge is too large or too crowded or too short term, it can create losses when the catalyst reverses. This is why hedges require discipline. You must size them so that being wrong is survivable. You must know whether they protect against a scenario or whether they are becoming a speculative bet. You must understand that markets can move violently against the hedge even if the underlying risk remains. A hedge can be right in concept and wrong in timing. That is why humility matters. Now, what about investors who were bearish and got squeezed? They may still believe the war risk is real. They may believe oil risk remains. They may believe inflation risk remains. They may even be right, but if they use too much leverage, they may not survive long enough to be right. This is another core principle in markets. Survival comes before correctness. A dead position cannot benefit from a later truth. If your margin call forces you out, being right 6 months later does not help you. This is why I care about leverage so much. Leverage compresses time. It turns a long-term thesis into a short-term survival test. If the thesis takes longer than your financing can survive, you lose. That is what happens to many smart investors. They are not wrong about the world, they are wrong about timing and leverage. Now, for an ordinary long-term investor, the lesson is different. Do not overreact to these short-term squeezes. If your plan is long-term, one violent rally does not require you to change everything, but you should understand that market highs can be produced by mechanics, not just fundamental improvement. If the world is still risky, if the strait is still disrupted, if valuations are high, if energy risk remains, then a record high stock market is not proof that risk is gone. It may be proof that a lot of bearish positioning was forced to unwind. That is a different kind of signal. It means the market is powerful but perhaps not safe. Power and safety are not the same. Now, I would also be careful about saying the stock market is gone. The old market is not completely gone. Fundamentals still matter over time. Companies still report earnings. Cash flows still matter. Valuations still matter. Bad businesses still fail. Good businesses still compound. But the short-term price-setting mechanism has changed dramatically. The market has become more mechanical at the margin. That does not eliminate fundamental investing. It makes patience more important. If you are a long-term fundamental investor, you must survive periods where price is dominated by flows, leverage, and options. You must not let every mechanical move convince you that value has changed. That requires understanding. If you do not understand the plumbing, volatility feels like madness. If you do understand it, volatility becomes information. Not always useful information, but information about positioning and structure. Now, what should you watch after such a rally? Watch whether physical conditions actually normalize. If Hormuz traffic returns to normal, if oil flows resume, if energy prices stabilize, then the relief rally may have fundamental support. If traffic remains deeply depressed, if oil supply risk remains, and if the ceasefire continues to fray, then the rally may be more fragile. Watch whether CTAs have finished buying. If the systematic buying wave is complete, one source of upward pressure may fade. Watch options gamma. If the market moves back into a stabilizing regime, volatility may decline. If negative gamma remains, moves may stay amplified. Watch hedge fund positioning. If shorts were fully squeezed out, the market may lose that fuel. If investors chase the rally and become crowded long, downside risk can rebuild. Watch oil. A renewed oil spike would challenge the market. As peace narrative, watch rates. If bond yields rise on inflation fears, equities can come under pressure. Watch breadth. If only a handful of large stocks drive the market, concentration risk remains. If many stocks participate sustainably, the rally may be healthier. These are the variables. Do not only watch the headline. Now, the source's final argument is that the stock market we all used to know, the one based on finding undervalued companies and investing for the long term, has been replaced by a giant feedback loop of algorithms, passive funds, and options dealers reacting to each other. That is partly true, especially in short-term market moves. But I would refine it. The market has two layers. The long-term layer still depends on earnings, productivity, innovation, balance sheets, competitive advantage, and capital allocation. The short-term layer is increasingly driven by flows, leverage, passive allocation, systematic models, and derivative hedging. Most investors confuse the two layers. They see a short-term mechanical move and draw a long-term fundamental conclusion. That is the mistake. A rally caused by a short squeeze does not necessarily mean long-term fundamentals improved. A crash caused by forced deleveraging does not necessarily mean long-term fundamentals collapsed. The serious investor distinguishes layers. That is how to remain rational. Now, let us connect this to Ray Dalio's way of thinking about systems. Everything is cause and effect. Cause. War begins and Hormuz is disrupted. Effect: oil risk rises and equities fall. Cause. Hedge funds sell aggressively and short exposure increases. Effect: the market becomes vulnerable to a reversal. Cause: a ceasefire headline reduces perceived uncertainty. Effect: prices rise. Cause: shorts lose money. Effect: they buy to cover. Cause: CTA trigger levels are crossed. Effect: systematic funds buy equities rapidly. Cause: options dealers are in negative gamma. Effect: they buy as price rises, amplifying the move. Cause: passive funds dominate index ownership. Effect: flows reinforce large cap index movement. Cause: multi-strategy funds use leverage and strict risk limits. Effect: risk reduction and position changes become mechanical. Cause: the market rises. Effect: media says peace rally, but the deeper cause is market structure. That is the machine. Once you see the machine, the rally stops looking mysterious. Now, what should you do personally if you are a long-term investor? Do not chase every squeeze. Do not become emotional because the market rallied against bad news. Do not assume war does not matter because stocks went up. Do not assume stocks must crash because war is bad. Build a portfolio that can survive both. Hold enough liquidity that you are not forced to sell. Avoid leverage unless you understand the risk deeply. Diversify so that one scenario does not destroy you. Use hedges carefully, not recklessly. Understand that headline narratives can lag mechanics. If you own broad index funds, understand the concentration and flow risks, but also recognize their long-term usefulness. If you trade options, understand gamma and dealer hedging because you are participating in the machine. If you short markets, understand that crowded shorts can be destroyed by relief headlines even when the fundamental risk remains. If you buy rallies, understand that forced buying can fade. This is not about fear, it is about awareness. Modern markets can produce huge moves without the world changing as much as the price suggests. Now, I want to focus on the philosophical point. People want markets to be moral. War is bad, so stocks should go down. Peace is good, so stocks should go up. That is emotionally intuitive, but markets are not moral. Markets are mechanical. They are also forward-looking, liquidity-driven, and position-sensitive. The market does not ask whether war is good or bad. It asks what was expected, how people were positioned, what liquidity is available, what price levels trigger flows, and how the next buyer or seller must act. This is why markets can feel offensive during crises. Stocks can rise while people suffer. Oil can fall while shipping remains disrupted. Risk assets can hit record highs while the geopolitical system is unstable. That does not mean the market is wise. It means the market is a pricing mechanism, not a moral judge. If you expect moral logic from markets, you will be confused. If you expect mechanical logic, you can understand more. Now, the 8th of April rally should teach investors that market moves are often second order. The first order thought is that a ceasefire is good. The second order question is how much short exposure existed before the ceasefire. The third order question is what systematic models do when price crosses certain levels. The fourth order question is how dealers hedge in the options market. The fifth order question is whether passive flows amplify the result. That is how you get from a headline to a record high market. Each layer matters. Most people stop at the first layer. Professionals who understand the machine look through the layers. Now, there is another lesson about oil and equities. When oil fell after the ceasefire headline, it reduced one immediate pressure on equities. Lower oil can reduce inflation fears, help consumers, lower input cost concerns, and reduce pressure on central banks that can support stocks. But if oil fell because futures positioning reversed while physical supply remained constrained, then the relief may be temporary. This is why physical data matters. Do not rely only on paper prices. Look at ships, look at flows, look at inventories, look at transit counts, look at refinery behavior, look at insurance and shipping costs. The paper market can move faster than the physical market. But the physical market eventually matters. If the physical problem remains, the price may have to reprice again. That is why one rally does not end the analysis. Now, the Nasdaq and SP returning to record highs does not automatically mean the market is healthy. A record high can be driven by liquidity, passive flows, concentration, and short covering. It can also be driven by genuine earnings growth. The question is, which force dominates? A serious investor does not celebrate or panic at the level alone. They ask what created the level. If record highs are supported by broad earnings growth, reasonable valuations, improving fundamentals, and falling risk, that is one thing. If record highs are driven by a squeeze, mechanical flows, concentration, and unresolved macro risk, that is another. The price can be the same. The risk can be different. That is why analysis matters. Now, what about people holding retirement accounts? If you are a normal retirement investor, the goal is not to interpret every CTA flow. It is to avoid making big emotional mistakes. If you sold during the panic because the war looked terrifying, you may have missed the squeeze. If you chase the rally at record highs without understanding the risk, you may buy at a fragile moment. The better approach is a rules-based personal plan. Rebalance when needed, keep contributions steady, hold enough cash for emergencies. Do not make all or nothing decisions based on headlines. Understand that volatility can be amplified by market mechanics. That is how a normal investor survives a market that is increasingly dominated by machines. You do not have to beat the machines intraday. You have to avoid letting them manipulate your emotions. Now, the fact that CTAs bought $86 billion in 5 sessions shows how enormous these flows can be. Imagine trying to interpret a market rally only through the lens of investor optimism while ignoring an $86 billion forced buying wave. You would misunderstand the move. This is why data matters. Positioning data, prime brokerage data, CTA flows, gamma exposure, options volume, passive ownership, leverage. These are not side details. They are part of the price formation process. If you do not know they exist, the market looks like a mystery. If you know they exist, the market looks like a system with triggers. Now, I want to be careful about one thing. A mechanical rally can become a real rally if prices rise enough, sentiment improves. If sentiment improves, investors allocate more. If companies issue good earnings, fundamentals can catch up. If oil remains lower, inflation fears can fall. If the war truly de-escalates, the original headline may become real. A squeeze can begin as mechanics and later become a durable trend, so you cannot simply short every mechanical rally. That would be another oversimplification. The correct view is probabilistic. Ask whether the mechanics created the move, then ask whether fundamentals will validate it. If fundamentals validate it, the rally can continue. If fundamentals do not validate it, the rally can fade. That is the right framework. Now, the problem in this case is that the underlying geopolitical and energy risks, remained unresolved in the source framework. Hormuz activity remained sharply reduced. The ceasefire was falling apart. The oil shock risk had not disappeared. Therefore, I would be cautious about treating the rally as a clean macro improvement. But I would still respect the rally because price action matters. Markets can stay elevated longer than a cautious analyst expects. Liquidity and flows can keep pushing. Short sellers can remain under pressure. Passive inflows can continue. Options can keep amplifying. That is why humility matters. Do not fight the tape with leverage. Do not trust the tape blindly. Study the forces. Now let us talk about the phrase, markets do not like uncertainty. It is true, but incomplete. Markets do not like uncertainty when positioning is not already prepared for it. But once everyone is hedged against uncertainty, a small reduction in uncertainty can produce a rally. The market is not reacting to uncertainty in isolation. It is reacting to uncertainty relative to price and positioning. That is a subtle but important difference. If stocks are expensive, everyone is complacent. And uncertainty rises, markets can fall sharply. If stocks have already fallen, hedge funds are heavily short, and uncertainty declines slightly, markets can rally sharply. Same concept, different setup. That is why context matters. Now, the old market story was about buying undervalued companies that still works for some people over long horizons. But it no longer explains every index move if passive funds own huge portions of the market and options activity drives intraday hedging, and CTAs buy tens of billions based on triggers, then the index can move for reasons that have nothing to do with the average company's long-term value. This can be frustrating for fundamental investors, but it can also create opportunity. If forced selling pushes good assets below value, patient investors can buy. If forced buying pushes prices far above value, patient investors can reduce exposure or avoid chasing. The key is to know when price is being moved by forced flow rather than fundamental information. That is not easy, but it is the edge serious investors try to develop. Now, what does this mean for the future? It means markets may remain more volatile than people expect. As zero DTE options grow, as passive ownership grows, as systematic strategies grow, as multi-strategy leverage grows, and as macro shocks hit a tightly wound system, price moves can become faster and more extreme. The market can gap up on relief. It can gap down on fear, it can squeeze shorts, it can punish longs, it can move in ways that feel disconnected from the news. This does not mean long-term investing is dead, it means short-term interpretation is harder. Investors need better mental models. The best mental model is cause and effect. What is the catalyst? How is the market positioned? What flows are triggered? What leverage exists? What hedging regime dominates? What narrative will people attach afterward? Then ask whether the move changes long-term value or only short-term price. That is how to think. Now, I want to return to the beginning. War is bad. Stocks can still go up. Those statements are not contradictory. War is bad for human beings. It creates suffering, uncertainty, destruction, and risk. But stock prices are not an immediate moral scorecard. They are outputs of a complex machine. If a war creates extreme bearish positioning and then a ceasefire headline triggers forced buying, stocks can rally even while the war remains unresolved. That is what happened. The market was not saying war is good. The market was saying shorts are trapped, Connecticut as are flipping, dealers are hedging, and passive flows are reinforcing the move. That is less comforting than the peace narrative, but it is more accurate. And accuracy matters because if you misunderstand why the market went up, you may misunderstand what happens next. If you think the rally happened because peace is real, you will expect stability. If the rally happened because mechanics squeezed a crowded short, then once that fuel is gone, the market needs real fundamentals to carry it. That is the key question. Now, what carries the market after the squeeze? If the answer is earnings, falling inflation, stable oil, and real de-escalation, the rally can hold. If the answer is only forced buying that has already happened, the rally may be fragile. That is the question investors should ask. Now, the final point is about personal discipline. Do not let financial media hand you the simple story and stop there. The simple story is often designed after the move to make the move feel understandable. But markets are rarely that simple. The real causes are often hidden in positioning, flows, leverage, and derivative exposure. If you want to survive this market, you must learn to see the plumbing, not because you need to trade every move, because you need to avoid being fooled by every move. A rising market can be dangerous. A falling market can be an opportunity. A peace headline can trigger a squeeze without peace. A war headline can trigger selling before the worst arrives. A record high can reflect forced flows. A crash can reflect forced liquidation. The market is not one thing. It is a system of many participants with different rules. Passive funds allocate, hedge funds manage leverage. CTAs follow trends. Dealers hedge options. Retail traders chase headlines. Institutions manage risk. Media creates narratives, prices emerge from all of it. That is the machine. Once you see it, you stop asking why the market is irrational. You start asking which part of the machine is moving. And when you can answer that question, you become less emotional, more patient, and harder to shake out of a good long-term plan. That is the real lesson of the 8th of April rally. It was not peace, it was positioning, it was not certainty, it was mechanics, it was not the old stock market, it was the new feedback loop showing its power in real time. And if you are going to invest in this market, you need to understand the loop before the loop uses your emotions against you.